Welcome to the world of futures and Forex trading, two markets that offer big opportunities for those who understand them. Futures trading is like pre-ordering an asset at today's price for delivery later, whether it's oil, gold, or a stock index. The aim? Profit from price changes between now and the contract's expiration. Forex, short for foreign exchange, is the world's largest market, where you trade one currency for another, betting on which will strengthen. Unlike futures, Forex trades have no expiration. You can hold positions as long as you want. Both markets use leverage, letting you control large positions with little capital, amplifying both gains and losses. Success demands discipline, strategy, and a deep respect for risk. In both markets, you're speculating on price direction, futures on commodities or indexes by a set date, Forex on currency pairs. Global news, economic reports, and political events can cause huge price swings. Mastering these markets means learning to anticipate and react to these events. High liquidity and the potential for quick returns attract traders worldwide. But these aren't markets for the uninformed. Education is essential. Whether you're trading futures or Forex, the core is speculation, making educated guesses about future prices. The right knowledge and mindset can unlock their profit potential. Ready to dive in? Let's break down the key differences and strategies. Futures and Forex may seem similar, but their structures are worlds apart. Futures are traded on centralized exchanges like the CME, ensuring transparency and equal access to price data. Forex is decentralized, an over-the-counter market where banks and brokers set prices, leading to slight variations. Futures offer contracts on commodities, energy, and stock indexes, letting traders specialize in sectors they know. Forex focuses solely on currency pairs, all influenced by global economic factors. Trading hours differ. Forex runs 24 hours from Sunday to Friday, while futures have set sessions and daily breaks. Futures contracts are standardized in size, quality, and expiration, like 1,000 barrels of oil expiring monthly. Forex trades in lots but with no expiration. You can hold positions indefinitely, paying or earning swap fees overnight. Centralization in futures means more regulation and transparency. Forex's flexibility comes with less oversight. Futures can have price gaps between sessions. Forex's continuous trading reduces this risk. Both markets require understanding of contract structure and timing. Knowing these distinctions helps you choose the market that fits your style. Each market's unique features shape your trading approach. Pick the one that matches your risk tolerance and interests. Next, let's see why traders are drawn to these fast-moving arenas. Liquidity is king. Forex is the world's most liquid market, and top futures contracts aren't far behind. High liquidity means you can enter and exit trades quickly, with minimal price slippage. Leverage lets you control big positions with small capital, amplifying both profits and risks. Online platforms have made these markets accessible to anyone, not just institutions. You can profit in both rising and falling markets by going long or short. This flexibility and accessibility attract traders seeking fast-paced opportunities. The key: understand the risks and use the advantages wisely. First, specialize. Focus on one futures contract like the E-mini S&P 500 and learn its patterns inside out. Know its trading hours, key news events, and support resistance levels. Second, use volume as confirmation. A price move with high volume signals conviction, while low volume warns of weak trends. Volume analysis helps you avoid false breakouts and bad trades. Third, always have a daily trading plan. Define your entry, target, and stop loss before the market opens. A plan keeps emotions in check and turns trading into a disciplined process. Watch contract expiration dates. Liquidity drops and price action gets erratic near expiry. Roll over to the next contract before the final week. Staying in the most liquid contract ensures smoother trading. Master these basics to build a strong futures trading foundation. First, trade with the trend. Identify the dominant direction on higher timeframes and enter on pullbacks. Don't try to pick tops and bottoms. Follow the prevailing momentum for better odds. Second, align trades with major news. Currencies react sharply to economic data and central bank decisions. Check the economic calendar before trading and use news as a catalyst when it fits your strategy. Third, practice strict risk management. Never risk more than 1 to 2% of your capital on a single trade. Always use stop-loss orders to protect your account from big losses. Consistent risk control is more important than chasing big wins. Futures and Forex offer huge potential, but only for disciplined, educated traders. Commit to learning, planning, and managing risk to thrive in these markets. With the right approach, trading can become a professional skill for life.